All right, sounds good. Thank you so much all for joining this morning. Appreciate you coming, taking the time to learn about your multifamily investing. I am Prashant Kumar. Along with me, I have Charles Seaman, who's going to talk today about the best practices in multifamily underwriting. We have Paul Senior also from Cash Flow Champs. We alternate, we come to these, we do these webinars just for education purposes only. Feel free to ask any questions in Q&A box, and we'll try to answer. We'll try to keep it to 30 minutes in the interest of everybody's time. Charles, go ahead. Floor is yours, sir.
Prashant, thanks so much for the introduction. So today we're going to be talking about best practices in multifamily underwriting. So what's important to look at when you're looking at a deal? So the first thing is you have to take the existing numbers. So any analysis or underwriting you're going to do is going to start with the existing numbers. So you're going to take the existing financial, whether it's a T12 or an income statement or whatever you're able to get from the seller, and you're going to input that into your underwriting tool. Depending on what type of deals you're looking at, you might create your own tool. You might use one of the plethora of tools that's available on the market. And there's all different types of tools. So you're going to take the income on a T3 annualized basis if you have a T12. What that means is you're going to take the last 3 months and you're going to multiply that subtotal by 4, so you get an annual total, and you'll take the expenses on a T12 basis. The reason you're doing it that way is because most lenders typically look at multifamily deals from that same lens. So when you're evaluating a deal, the last thing you want to do is think that you have a good deal, but the lender thinks otherwise. So you want to look at from the same perspective that they're going to. So after you take the numbers and you plug them into your underwriting tool, the next thing you're going to start doing is you're going to start building out any projections or pro forma that you have. So what's important when doing this? Well, there's a few factors that are very key. First one's going to be debt. So most of us here are using debt to acquire these properties. If you're using debt, there's a good chance that it's probably going to be one of the biggest factors in your underwriting. So you need to have good assumptions for the debt. Now, initially, when you're doing a first pass at your underwriting, that might be fairly quick, and you might put some assumptions in there for all of the different things that you need to follow up on. So where the work is really going to come in with the underwriting is all the follow-up and confirming the assumptions. Keep in mind that your underwriting is only as good as the assumptions in it. Anybody could show a 25% return on a deal, but if you can't actually deliver on those assumptions, then the underwriting is worthless. So one thing you want to check after you do your initial underwriting, if the deal shows any potential, is you want to get that debt quote or a financing quote. And you're going to do that by reaching out to a mortgage broker or to a lender, and you're going to put the financials for the deal in front of them, so that way they can review it and give you high-level terms that you can use in your underwriting. So there's a few different types of debt that are out there. When you look at the property, you want to figure out which type of debt might be best suited for it and underwrite it from that perspective. Typically, if it's a stabilized property with 90% or more physical occupancy, we look at it from the perspective of agency debt, which is Fannie Mae or Freddie Mac, and we plug in terms that are commensurate with that. If you're looking at a property that's a bit of a heavier lift, and maybe it has lower occupancy, maybe it has a lot of delinquency, maybe it has a lot of deferred maintenance, and you're buying the property at a discounted price because of that, then you're probably going to need to use bridge debt or hard money, and you'll need to adjust your underwriting accordingly to reflect that. So aside from debt, you'll also need to go out there and get an insurance indication. So an indication is like a soft quote. And what you're going to do is you're going to give the insurance broker basic information about the property. I typically provide them with the financials and the OM if there's one for the deal. And that way they can give you a high-level overview of where they expect the insurance to be at. So for anybody who's been underwriting deals recently, one of the things you've probably noticed is that insurance has been very volatile in recent months. So because of that, it's something that you want to make sure you have a good number with, so you can really protect yourself and your investors as you underwrite. So insurance, broker relationships will be important, and make sure you get those so you can input that in your underwriting. Another thing is your income and expense assumptions. So the last couple of years have been really wacky compared to historical norms. And for anybody who's been following the market for a long time, you're probably aware that much of the rent growth we've seen in the last decade has probably been on the high side. And particularly in the years of 2020 to 2022, post-pandemic, we saw astronomical rent growth. So if you were the beneficiary of that rent growth by owning property at that time, that was probably great for you. But if you're on the buy side now, you don't want to be assuming you're going to be achieving that same level of growth going forward. Keep in mind, even though there is data to support that growth for 2 years, it's probably very unlikely that it'll continue at that same rate. So one of the things you want to do is speak to people who are investing in the market. You can speak to other investors, you can speak to brokers, you can speak to property managers, and understand what a normal trajectory is for the market you're investing in. Now, keep in mind, guys, one thing very, very important about underwriting or about real estate in general is that it's very localized. So if you're looking at properties in different areas, the numbers that you use in your underwriting or the metrics that you use can be very different. So if I was underwriting a property in New York versus Indiana versus California, I might have 3 very different expectations of where my income and expense assumptions could be. So knowing the market and really being in touch with people that can give you that information on a regular basis, that's going to be very important. So in order to really determine if you have a good deal, you need to know if you can hit the income and expense projections that you're putting in there. Another recommendation I would make is on the expense side. One mistake that I see people make is a lot of times they're looking at the expenses solely as a percentage of the income. And while that's good for simplicity, what I find is oftentimes it doesn't really give you the full picture. So getting to know the markets you're investing in and understanding what things cost on a per unit basis will actually give you more of an advantage as you do your underwriting to make it more accurate. Another thing, and a really big thing I would say, that's important when you're underwriting is property taxes. So oftentimes your biggest expenses on any multifamily deal, at least one that's large enough to support staff, are typically going to be property taxes and payroll. So, and even on deals that are too small to support payroll, you're still going to have a big expense for property tax. So it's very important to understand how that number is going to be underwritten after you buy the property. So you need to reach out to the assessor in the county or city you're looking in, and you need to understand when they're going to reassess, how they're going to determine the valuation for the reassessment, and whether or not a sale is going to impact that. So some states are what they call point of sale states, which means that they're reassessed sooner. For instance, we look in North and South Carolina. So North Carolina is not a point of sale state. So that means that if we buy a property there, it'll reassess whenever the next scheduled reassessment for that particular county is. South Carolina, on the other hand, is a point of sale state. So that means if we buy a property, it's going to reassess the following year. Of course, the assessor doesn't want to wait for the next scheduled reassessment. They want to get that valuation sooner. So make sure you understand that, because that can really be a very, very important factor in your underwriting. When I tell you that I've seen tax numbers double and triple, from where they are at acquisition until that reassessment, I'm very serious about that. And there's times I've even seen them quadruple. So when you're dealing with a 6-figure line item, you can't afford to be that far off. Make sure you do the homework to understand what that reassessment looks like, because that's going to be a very, very key component. So those are probably the major things you need to confirm and follow up on after your initial underwriting. Now, what else is important? Well, obviously purchase price is important. So, they always say the one mistake you can't correct is if you buy wrong. And there's a lot of truth to that. If you pay too much for a property, you're going to own that property at that price for perpetuity. So you need to make sure you feel confident with the number you're buying in and that you're buying at a price that makes sense. The second thing I would tell you is terminal cap rate. So behind purchase price, terminal cap rate is really the second biggest thing that can impact your returns. So if you're buying a property for yourself or as a JV, and it's more of a buy and hold property, terminal cap rate may not be as important to you because maybe you don't plan to sell the property. But if you're syndicating or if one of your exit strategies for the investment is eventually a sale, then terminal cap rate can be very important. And there's no exact way to do this because unfortunately, none of us have a crystal ball. So what'll happen is you have to use your own market knowledge, knowledge of other investors you speak with that are familiar with that particular market, and knowledge from brokers, along with any information you can find that can help you determine where cap rates are now and where they're going to be heading in the future. So keep in mind, you could ask multiple different people and get multiple different answers. So you'll have to be able to compile that information and then make an informed decision, because that's going to be a very important part of your underwriting. A couple more takeaways that I would offer to everybody here. So the one is with the income and expense assumptions. So aside from just any bump you might get from doing a value add play, that's usually going to be over the first 1 to 3 years based on how big of a play it is. But you're also going to have ongoing escalations, and that's going to be on both income and expenses because things don't usually stay the same in cost. They go up over time. So make sure you're using realistic assumptions. A lot of times, for most properties at this point, I'm using 3% annual rent escalations for properties and 2% annual expense escalations. Now, the reason I use those is because those are historical norms in most markets. The last couple of years, again, you could certainly find data to go for different numbers other than those. Make sure you're being realistic with what's historically normal for a market versus just a shorter period of time. And also on the debt side, something else to think about is your underwriting. If you're using floating rate or adjustable rate loans, you want to make sure you're budgeting money in there for a rate cap. Rate caps right now are very expensive, so you want to make sure that you're getting pricing on that and that you feel confident in the number you're budgeting so you don't wind up short at closing. And also make sure you put in CapEx money and reserves. So the CapEx will vary from property to property. Some properties are going to be very heavy in CapEx. Maybe they have a lot of deferred maintenance. Maybe they need a lot of upgrades. So for that, you'll need a bigger budget most times. Some properties will be pretty well maintained, and you may just need basic stuff that'll allow you to go with a lower CapEx budget. On the reserves, my general rule of thumb at this point is if you're starting with a value add property or workforce housing C-class asset, you probably want to be using 8 months of your pro forma operating expenses as reserves. That way you have enough money. And if you have a nice, cleaner, stabilized property, maybe an A or a B asset, I would recommend dropping that down to 6 months. So keep in mind, guys, one of the mistakes that a lot of people are going to make is they're not going to have enough money. So the last thing you want to do is run out of money as you're running these properties, and make sure that you have enough that you can actually go out there and execute whatever plan you have in place. Prashant, do you want to open up for a couple of questions and we'll have people put them in the chat box?
Yes, definitely. Let's open up for questions on the multifamily underwriting and see what questions folks have.
My guys, if you have questions, just throw them in the Q&A box and we will answer them for you.
And while people are thinking about the questions, if you want to schedule a call with us, feel free to scan the QR code on the left-hand side. We do have Saturday underwriting sessions, which are free of charge, absolutely free. Charles from them every Saturday at 4 p.m. That's the middle QR code. And if you guys want to do business and want to be part of the inner circle, feel free to go on to a waiting list. We have a small inner circle where we do deals with the students. Feel free to scan the right QR code, and basically, somebody will talk to you to see if you are a right fit. So I have a question here from Veronica. Where do you find how counties assess taxes, whether point of sale or not?
Veronica, good question. So typically what I recommend doing is I just do a quick Google search and I type in the city and state or the county and state that I'm looking in, along with the words property tax assessor. And what will usually happen is that'll give me the website for the local assessor. Most of them do have online presences nowadays. And what I typically do is I send an email to them with 3 questions. The first one I ask is, when is their next scheduled reassessment? Second is, how do they determine the value of the reassessment? And third is, would a sale impact how soon they reassess? So I do it in writing because I like to get the answer in writing. Most counties typically will respond. If I find that they, for whatever reason, don't have an email or that they're unresponsive by email, then I would typically just pick the phone up and call them. So what I would tell you is you don't necessarily want to take that information from other investors or from other professionals, even just because it's such a big line item. So always make whatever effort you can to get in touch with the assessor's office themselves and make sure that you understand the process.
Great answer, Charles. The next question is from Carlos. How has the current interest rate environment affected your decision making?
Well, it's made it a lot tougher, I'll tell you that much. So I don't think it would necessarily impact decision making, because the thing is, regardless of what rates are, you're going to be building, at least as much of it as you can predict into your underwriting. So, in terms of like actual deal flow, what it's done for us is it's made us not really be competitive on anything with new financing. I don't believe property values as a whole have dropped enough to really make sense with where rates are at the current time. But if it deals with attractive loan assumptions, some of those are at prices where they do actually make sense. So, we've been focusing more on those because you're getting the benefit of, a lower price than you would have got 2 years ago, and great debt. So sometimes that can make a deal pencil out.
I don't see many questions, Charles. If you want to jump into the next segment of this presentation, we can talk about what we have. If you want to talk about Archway, do you see my screen?
Yeah. So guys, with this here, so this is actually an investment opportunity that we are working on as a team right now. One quick thing I would say is this opportunity is only for accredited investors. So if it is something that you had interest in, you could speak with Prashant or Paul, but just keep in mind you would have to be accredited to invest in this opportunity. So, to call us this question, I'll tell you what we do like about this one. So what we like about this one is that it has great debt. So it has a loan that was taken out when interest rates were very, very low. It has a good amount of time left on that loan, nearly 7 years. And it has actually a senior and a supplemental loan with a blended interest rate of 3.79%. So that's great. We also like cash flow. So the cash flow is pretty strong over the life of the investment. It's north of 7% on average. In year 1, it will start out a little bit low because this is a value add play. And as we get the property moving in the right direction, what will happen is then we'll start to realize more and more of the cash flow. And it's also a property that's had a lot of investment from the seller. They put approximately $1 million into the property by upgrading roughly 60% of the units in different ways. And that will give us a lot of momentum to, really take this property and hit the ground running with.
So Charles, basically the purchase price here is 13.4 million.
Mm-hmm.
And we are raising about 6.1 million, right?
Right, correct.
And the loan amount is about 9.8 million on this, which we are assuming.
Correct, yep.
So the equity has to come from accredited investors or pref equity guys, basically, in this deal.
Right.
So the next slide for this is basically, return projections, if you want to talk about it.
Yeah, sure. So with this particular one here, this slide is an overview of what it might look like if somebody was to invest $100,000 in the deal. And what it's showing is that in year 1, you get cash flow of about $4,000. And you'll notice in year 2, that goes up, and it continues to go up throughout the life of the investment. So for a $100,000 investment, you would roughly expect to receive approximately $36,000 in cash flow over the life of the whole period, which is a 5-year projection. And you would project to receive about $55,000 in a lump sum on the back end when the property sells. So in total, it'd be roughly $92,000 between cash flow and proceeds from sale. And that works out to just north of an 18.5% average annual return.
So there's one question here from Carlos. Is a value add play more risky in our economic environment? How ambitious is the value add rent upside?
Good question, Carlos. So there's a lot of different perspectives. You could probably ask this question to 10 different people and wind up with 10 different answers. So my perspective is that I think it really varies from opportunity to opportunity. And I think, the real key to this opportunity specifically is the debt. So the reason it makes sense is because of where the debt is and because of how much time is left on the debt. So I think there's a lot of factors that go into it. Now, like this specific opportunity, there's rent comps that are achieving higher rents than the subject property now. And what's happening in a lot of markets? Well, in a lot of markets, rents are flattening. Some markets are starting to go down. So when you think about it, from 2020 to 2022, a lot of markets saw the equivalent of a decade's worth of rent growth. So we're seeing a little bit of a reset right now because a lot of that's adjusting as it's getting back to a more normal level that people could afford. So one of the things we like to look at is where the rents are now for the comp properties. And even if those rents drop, we're projecting targets that would still be fairly conservative considering that. So most times it's rare that you see rents drop significantly. In the last 60 years in US history, on a nationwide level, there's really only been a short 3 to 4 month period where rents have dropped. And that was in 2010 after the Great Recession, during the Great Recession, I guess you could say. So overall, I'd say it's probably not that risky if you have enough time and if you have ample capital. Where I think it gets risky is if you don't have a lot of time in your debt, if you don't have capital to run and execute the plan properly, and if you're projecting targets that are unrealistic. So I think as long as the assumptions make sense, then you're generally okay with that.
This is awesome, Charles. Thank you so much. And here on the screen, I have 3 QR codes. If you want to know more about this investment opportunity, we had done a webinar, which is the leftmost QR code. And if you want to see the slide deck for this opportunity, that's the middle QR code. And if you want to know more about this deal and go to our investment portal, the rightmost QR code, you are better off taking the screenshot of this slide. That way you have all the 3 links available to you. I think that's all we have today. I don't see any more questions. But Charles, thank you so much for jumping on for a
Thanks
short
for having me.
notice.
It was nice seeing everybody.
Sure. And remember, at Cashflow Champs, we are helping investors gain financial freedom through passive investing. Besides passive investing, we have a club in our circle for active investors also. So please feel free to reach out to us if you want to know more about it, and we will start the conversation. We are doing deals with our investors, and most of the students that we have here with us, they are already doing deals with us in the last 3 to 6 months. Carlos, thank you so much for appreciation. Thank you so much, guys.